Hello everyone, I'm Miles. Why do some companies suddenly invest billions to expand production, while at other times they're completely unwilling to invest? Why does lowering interest rates stimulate the economy? Why does the commodity market eventually return to equilibrium on its own? Today, through a comprehensive macroeconomics problem, we'll truly understand the core logic behind capital stock, investment decisions, and IS goods market equilibrium in a closed economy. One of the core ideas in modern macroeconomics is that companies will only invest when the expected returns from capital are high enough. This cost is called the user cost of capital, or U. The key condition is that the future marginal product of capital, MPK_F, equals UC divided by 1 minus 10. Let's learn by solving a problem. ABC company faces a real interest rate R of 8%, a depreciation rate delta of 12%, a capital price PK of 4,000, and a tax rate tau of 20%. First, let's calculate the user cost of capital. UC equals R plus delta times PK, which is 0.08 plus 0.12 times 4,000 equaling 800. Next, adjust for the tax rate. 800 divided by 1 minus 0.2 equals 1,000. This means that for the company, adding one more unit of capital must generate at least $1,000 in future returns for the investment to be worthwhile. Next, let's calculate the optimal capital stock. The problem states that the marginal product of future capital, MPKF, is 1,400 minus 0.1K. The company will choose 1,400 minus 0.1K equals 1,000, so K equals 4,000. The company's ideal capital stock is 4,000 units. The essence of investment is to continually bring the actual capital stock closer to the optimal capital stock K. Next, let's move on to goods market equilibrium. The goods market requires that desired savings equal desired investment, so SD equals ID. First, calculate savings. S equals Y minus C minus G. Substituting into the problem, SD equals 1,020 plus 5,000 times R, and the investment function is ID equals 1,500 minus 4,000 times R. Setting the two equal, S equals I, so the equilibrium real interest rate is 4.36%. Next, the government introduces an investment tax credit, reducing the effective tax rate from 20% to 10%. At the same time, optimistic expectations for high-tech demand have raised future productivity. Lower tax rates reduce the cost of capital, while higher future productivity increases the marginal return on capital. Both of these forces will drive companies to increase investment, so the investment curve shifts to the right. If investment spikes, the goods market unbalances because investment exceeds savings as demand for funds outstrips supply. Consequently, real interest rates rise. This curbs investment and boosts saving until savings equals investment demand, restoring market equilibrium. We can see that the capital stock determines future production capacity, investment determines the direction of economic growth, and the real interest rate under goods market equilibrium is the most crucial coordinating mechanism for the entire economy to find balance. Countless businesses, households, banks, and investors constantly adjust their decisions based on the interest rate as a price signal. In the end, the economy is never a static formula, but a dynamic system that continuously self-adjusts through incentives, expectations, and prices. Equilibrium is not something that is designed, but rather the natural result formed through the interaction of countless rational decisions.